Hello, good morning to you all. It's a pleasure for me to welcome María Nieto to this seminar. She's a member of the Advisory Council of the Institute to International Monetary Research and a senior economist at the Bank of Spain. She's an advisor in the Bank of Spain. Her focus has been on prudential regulation, financial stability, and crisis management. She's an author of several articles that have been published in peer-reviewed journals, and she's the member of several editorial boards of different journals, academic journals. She has worked at the European Central Bank in Frankfurt, the Council of Economic Advisors to the Spanish President, the European Bank of Reconstruction and Development in London, and the IIMR in Washington. She earned an MBA in finance from the University of California in Los Angeles, and also a PhD degree at the University in Madrid. Again, she's an expert in financial regulation and financial supervision. And today she's going to talk about banks, climate risk, and financial stability. So the floor is entirely hers. We're going to have a 40 to 45 minutes presentation and then a Q&A time for your comments and questions. So thank you very much, Maria, again, and the floor is entirely yours.
So now we move on to the Financial Stability Board classification of climate-related financial risks. Next slide, please. There are three types according to the Financial Stability Board. One is the physical risk, the other one is the transition risk, and the other one is the liability risk. What is the physical? What is the physical risk? Is the direct impact of natural disasters related to climate change on lives, real estate, or infrastructures. And here I put you the example of Hurricane Irma that devastated some of the islands in the Caribbean in 2017. What happened? Some of the real estate that it was more affected, it was pledged as collateral for loans. So what happened? That those loans lose the value of the collateral. So there is a loss of value on that sense. Then public infrastructures were devastated and governments need to reinvest in those public infrastructures with an impact on the sovereign. So there you have how the credit risk of the sovereign would be affected. Next slide, please. From the financial point of view, for us as financial stability experts, is the transition risk the one that we perceive as the largest risk? Is so-called climate policy risk? Is the financial risk which could result from the transition to a low carbon economy? And in this transition, we expect to have policy action. And this risk stems precisely from this policy action. This policy action that is going to materialize in three forms. Technological standards, where regulators specify the technologies that potential polluters may adopt, for example, emission limits, which is a centralized form of pollution control. The next is emission taxes as per unit of pollutant. This is going to have an impact on the cost structure of corporates, as we will see later. And the third form of control is emission permits. As you may have heard, there is a so-called cap and trade market for CO2 emissions. I think they have it in California, in the US. We have it in the European Union, although it's restricted to the highest polluting sectors like aviation industry, electric sector, and industrial sector. So it's a price form of control. Of course, it's not a perfect market. But this transition risk materializes over a long period of time. We'll see how some climate models have time horizons that get to 2100. And we will see how this can have an important impact on the value of financial assets. The third type is the liability risk. And here is a risk that affects particularly to insurance companies, but not only to them, because it could affect the corporates themselves, as the example that I'm putting here. Parties who have suffered the loss or damage from the effects of climate change seek compensation from those that they hold responsible. And this is what happened with a utility company in California, PG&E, that is facing huge legal liabilities because there was a doubt that the possibility of its equipment could have been involved in starting the devastating wildfires of California in 17 and 18. So, for example, just to give you an idea, P&G has responded to that, and in 2019 it shut off its plants and left many pockets of population in California with no light for several days because they were very afraid of being sued for this reason. So this gives you an idea of the economic implications that this liability risk may have. Next slide. Although we will go back to this, let me highlight that it is very important for us who look at the financial implications of climate risk to look at transition scenarios. These transition scenarios will help to analyze how the world might achieve certain temperature in centigrades. Assume a specific link between CO2 emissions and climate impacts, and we will see that also on GDP, and illustrates the connection and the dependencies across technologies, policies, and geographies. So this is not a forecast. It's simply an assumption of how all these variables are going to interact. The fact that these models have very long time horizons, as we will see later, it doesn't have anything to do with forecasts, because forecasting 100 years ahead of us is not a good forecast. These models have these very long time horizons because these risks materialize over the long time. Although there is already some evidence that they are materializing earlier than we thought. Here I put an example. This is what has been used by the Central Bank of Holland, in which you can see, for example, there is a combination of technologies, breakthroughs, and policy stances, in which you can see that this may end up resulting in a combination of policy and technological shocks that are going to have an impact on the value of assets. Next slide. So what I plan to do next, just to give you an idea of the dimension of what we are talking about, is present just a summary of recent research that I've done on the loan exposure to elevated climate risk sectors of the banking systems in different countries. And this is what I found. Note that this graph represents the exposure of the banking system of these different areas of the world. CN is China, CH is Switzerland. And what I focus on is syndicated loans, because the information on the bilateral loans we simply do not have. And what we have, because it's public, I use the Thomson One database to do this research. Is the information on the syndicated loans. You also have to bear in mind that these corporates that operate in these high environmental risk sectors are generally utilities, large corporations that they heavily tap the syndicated loan market. So this exposure gives you definitely a quite accurate idea. And what we see here is that the European Union is the banking system most exposed. Probably the case of the US having a smaller exposure could be explained by the fact that markets are more developed in the US than they are in Europe. So there will be a larger cohort of corporates that tap directly the market. The case of China definitely gets our attention because we know that China is heavily exposed to high environmental risk sectors. And I think that the small share of China via bilateral loans from banks, I think it has to do with the fact that most of these loans in China are provided by sectoral banks, and they are bilateral loans. So the bank directly lends to the corporate. It doesn't go to the syndicated loan market. Next slide, please. So in these 5 areas of the world, the 3 sectors that concentrate the largest exposures to high environmental risk sectors are the same 3: oil and gas, power generation, and automobile manufacturing. And automobile manufacturing shows as the last one in all the cases. Oil and gas, most important in the European Union, most important in Japan and Switzerland, while power generation is most important in the US and China. Next slide. Now we put the magnifying glass in the EU banks. Almost 30% of the exposures are concentrated in oil and gas, and the next that is barely 28% approximately on power generation, and the third one, automobile manufacturers. Other sectors are steel, chemicals, building materials, and so on. Next slide, please. Now we get to the policy approaches and the tools, and next slide. Here, I think the most important tool is to have an harmonized taxonomy. Chinese went ahead of everybody else. They have their own taxonomy already for, I think, 2 or 3 years. And I'm here presenting the case of the EU, that our taxonomy is a taxonomy that has been published recently. I think it has been March of this year, just about the time we were confined. And there are certain characteristics. This taxonomy is not a strict taxonomy where it tells you industry by industry, within sector by sector, because sets performance thresholds, technical screening criteria for economic activities that are considered sustainable. What are the 3 criteria that any sustainable activity should meet? First, the sustainability should contribute to at least one of the 6 environmental objectives that the regulation has set as main objectives. And these are either contribute to climate change mitigation, climate change adaptation, protection of water and marine resources, transition to a circular economy, pollution prevention and control, protection and restoration of the biodiversity and ecosystems. So at least to one, and ideally to all. The second condition should be that if contributes only to 1, 2, or less than 6, that it doesn't harm the others to which does not contribute directly, okay? And the third condition is that the corporate should meet certain safeguards. For example, the OECD guidelines on multinational enterprises, the United Nations guiding principles on business and human rights. Of course, in this classification, they are excluded from the start the fossil fuels, which are by definition not going to meet the first condition. I think I want to bring your attention the fact that this taxonomy is green because all the risk analysis that we are going to see later, and it has been done in terms of assessing financial risk, is based in brown. Because what is assumed is that it is the brown that causes the risk. So all our analytical tools and all the climate models are built on CO2 emissions. So basically, this taxonomy is not very helpful to our existing framework of analysis, how we have it and how it has been based on all the climate models that at this moment they are available. I mean, from the models used by the environmental agency at the OECD to the integrated assessment models that I will discuss later. And these are the models that have been used, for example, by Nobel Prize Norhaus. So this is important because the Commission has helped us to a point. At a certain point, we are going to need a brown taxonomy. There is little doubt about that. Next one are the call reports. I'm not going to insist in this very much, but not only we need a taxonomy, but also we need the supervisory reports to capture well what is the exposures to these sectors. Next slide. I'm also not going to get into this in much detail, but also there is a lot of emphasis on disclosure. And in Europe, for example, there are already legislative initiatives and proposals that they will see the light very soon on disclosures and also on benchmark regulator for asset managers. Next slide. Okay, here is where I would like to make more emphasis and I would like to spend more time. I think there's a common consensus that climate stress testing based on a scenario analysis is a very valuable tool to assess the financial stability implications of climate change. These stress tests, they can be done at the bank level, but they also can be done at the system level. What I'm going to present here, as I said at the beginning of my presentation, is the work that has been done at the Network for Green the Financial System, where we have 65 countries represented there, and there are 12 observers, including, for example, the Basel Committee, the BIS, the IIMR, and the World Bank, just to name some. So this, what I want to say is that there is some intellectual consensus. It's not the only thing, but there is some intellectual consensus. And let me highlight that the assessment of the impact of climate change and financial stability risk is less canonical than the traditional system-wide financial stress testing. For example, climate change and the policies to mitigate it will develop over many, many, many years. And this is not the typical time horizon of a stress test, which is, for example, for the Bank of Spain is 2 years, for the Bank of England is 5 years. But there are ways to adjust. Okay, and we will discuss that. Also for the assessment, for example, of the credit impact, same thing with the market risk impact or the liquidity impact, these transition scenario outputs, which are very elaborated outputs that put together many things that we will see later, need to be financially interpreted in terms of the corporate financials. And we will see an example later in order to bridge the gap between climate scenarios and financial risk assessment. Next slide. Here, I present in this figure, I think a very condensed integration of climate risk variables, macroeconomic and financial variables for climate risk assessment. I think we talk about the physical risk and the transition risk, and these are the ones that are being modeled by climate scientists. So the inputs we are going to use to assess or to reassess our GDP growth, our productivity, our real rates of return or long-term real rates of return. We are going to use inputs that are based on physical scenario and transition risk scenario. And I already defined what they are. For example, in physical scenario, increases in temperature, increases in frequency and severity of weather events. On transition scenario variables, we are going to see, for example, CO2 emissions, the price of CO2, commodity prices. Very important is that whatever variables we use on our physical and transition scenarios, they have to be consistent. So we have to use the same assumptions on CO2 emissions. We have to use the same assumptions on technology. If we assume for the transition risk that everybody's going to use bicycles, as of 2030, we have to make exactly the same assumption to assess the impact on physical risk. We have, of course, to make the same assumptions on prices, okay? So, and of course, we have to use the same time horizons. This interacts with some macroeconomic variables. Here, I put you an ideal world of all the variables that we may have, but we may not have them all, okay? So we interact these scenarios with macro and financial variables in the context of the so-called integrated assessment models. This is why they are called integrated, because what they do is they integrate the climate part with the economic part. These models have very long time horizons. Generally, purely, these models, as I said before, they use time horizons of 2100 with the flexibility to use shorter ones, because of course the models realize that the objectives of the net zero CO2 emissions were not for 2100, but for 2050 or 2030. So they have been adjusted to this. There are several, and they are managed. For example, the Potsdam Institute has one that is very widely used. These are the models used by Nordhaus to assess what would be the impact of taxes on CO2 emissions and the impact on growth. Very important is that the shocks results are heavily influenced by the integrated assessment model assumptions. For example, if there is a technology switching due to the cost minimization, okay, we come to the conclusion that we are going to shift to this technology that is going to produce cheaper energy. So this definitely influence very much the model, which I think you can expect, because I told you that assumptions have to be consistent for the scenarios. The other limitation is the fact that these models do not include equations with the financial system. This is, by the way, a common criticism of most macro models. And then in the past crisis, this came out very clearly. Macroeconomic models never consider the financial risk, or they didn't have the financial sector model in. And for the integrated assessment models, which are also all models because they have been there for quite some time, the criticism is the same. So the interaction of all these variables are going to be the input of macroeconomic models. The macroeconomic models that we use at the Bank of Spain, the Bank of England, or whatever, general equilibrium, partial equilibrium, so they are going to be used there. The advantage is that we will have, for example, GDP by region of the world, by province, sector. Ideally, these integrated assessment models should be granular, and this granularity would be incorporated in the macro models. Sometimes they are sufficient. I mean, whatever the integrated assessment model produces is sufficient for us to include as an input for our credit market or liquidity climate risk assessment risk for financial institutions. So whatever we're going to get from these climate models is going to be a GDP adjusted by climate risk, physical and transition. We will get a labor productivity adjusted by this risk, or if they produce, for example, any financial variable adjusted by this risk. Next slide, please. Okay, the climate risk scenarios. What we are using in the network for greening the financial system is a combination of physical and transition risk. This transition, as we said, it could be orderly if governments have a forward-looking, time-consistent, and timely action, and the markets do internalize those signals in an orderly fashion. And of course, whether markets can produce the technology that is necessary to meet those objectives, okay? So as a result of this, we are going to have scenarios of high physical risk and disorderly transition. We can have also scenarios of low physical risk and orderly transition, or we can have, for example, a hothouse world. It's in a scenario of very high physical risk where emissions continue to increase, and still the transition is orderly. There in triangles, I show what will be the price of carbon. The price of carbon will depend on whether the action is immediate or not. Will depend on whether there is any action, as I said before, that is consistent with the market expectation that the technology is available. For example, this triangle in the upper left part of the graph shows in a scenario where the objective is met because we meet the objective of the 1.5 degrees by 2050, but there's no the technology, there is no available technology. So in order to meet that objective, the price of carbon is going to be very, very high, okay? So larger, more ambitious objective and faster would increase more the CO2 prices. Next slide, please. Is this the only approach, the approach we're using by the network of greening the financial system? I think it's important that you understand that it's not the only approach, that there are other approaches that have been used by academics, but also by consulting, climate consulting companies, and this is the so-called climate value at risk. The climate value at risk is a forward-looking and return-based valuation assessment to measure climate-related risk and opportunities in an investment portfolio. So what they are using, those that are using climate value at risk, the quantitative results of the simulations of lots of climate transition scenarios provided by several integrated assessment models. So they are using a lot of scenarios, and this is fundamental to assess how wrong the assessors could be in computing the climate value at risk on individual portfolios. So it doesn't get into the macro economy and how this risk transmits through the entire economy and goes more to the value of assets. It's a refined version of the capital asset pricing model used for climate and with not so stringent assumptions. Next slide, please. Okay, how we get from all of this to the probabilities of default? Because we, in a stress test exercise, what we want to get to is to assess the probability of default of a particular borrower. So we incorporated all of this on our corporate financials, in the revenue, in the cost, on the capital expenditures, and we also have to take into consideration what is going to be the management response. Partly this management response, you would expect that is also consistent with the scenarios. The managerial response is going to be also explained by the government policy action. And so we are going to have a scenario adjusted corporate financials that are going to be the input on the credit risk model. And so we will get a probability of default. And I thought it would be useful to use a very particular case with a power generation utility. And this is what is in the next slide. So here you have, for example, a power generation utility. The borrower has certain characteristics, is using a particular energy mix. It has particular cost of fuel, and it has a target energy mix. So it may be shifting, for example, from fossil fuels to renewables. We are going to use also as an input the scenario analysis, the electricity price, the fuel cost, and the carbon price. And with these inputs, we are going to reassess the borrower characteristics. We are going to reassess our revenue, our cost, and our capital expenditure. So, for example, on the revenue, our revenues will change whether we want to shift more towards renewables or the demand will be more coal fuel. It may happen that our clients want to use clean sources of energy. The cost will be very much determined by taxes, by permits to pollute, and the capital expenditure will very much depend on our commitment to shift to clean sources of energy. And in this way, we will have a scenario adjusted performance metrics. We will have a reassessed cash flow or EBITDA. And these are the ones that we are going to use to calculate our implied probabilities of default for this particular borrower. Next slide. So in a very simple way, what climate risk is doing is increasing our existing risk. It's a shift of our probability of default curve. Next slide, please. Another, and now very much into discussion, approach to deal from the financial point of view with the risk, with the financial risk posed by climate risk, is regulation. At this moment, we are already at the stage where climate risks have a permanent impact over the business cycle, and here there is a debate on what approach to use, whether they are going to be the capital requirements are going to be brown penalizing factors or green supporting factors. Into all of this, I will go next to explain to you how a green supporting factor works. But basically, for the brown penalizing factor, what you do is say, well, I'm going to increase my risk weight, so I'm going to use a prudential supervisory tool to penalize sectors that are more brown. And with the green supporting factors, what I'm going to do is I'm going to shift the risk weights to a lower level for those sectors that are green. But I will get to this next. Before, let me tell you that there is a common agreement on the need of transparency requirements. On this, there is a wide consensus. There is no debate whatsoever. And banks, financial institutions, and corporates are under more pressure. And there are even international standards by now imposed by the Task Force on Climate-Related Disclosure. There is a task force under the aegis of the Financial Stability Board that they are already telling to each sector how they should report on their climate risk. And they put this risk at the same level as they put the other financial risks, like credit risk, market risk, or liquidity risk. Next slide, please. So this is how a green supporting factor works. This is a very simple case where you have exposures, you have the risk weights, and let's assume the very simple case where each exposure has a risk weight of 100%. So by imposing a green supporting factor, you multiply your risk weight by beta, and this beta is lower than 1. So it's going to reduce the risk weight for the same exposure. I think it's important that you take into consideration the different incentives. A brown supporting factor will reduce the supply of credit because it's penalizing the risk weights, but it has an uncertain impact on the portfolio. It's not clear whether the banks will use these liberated resources of capital to invest in neutral, green, or another brown that has lower credit risk. While in the case of the green supporting factor, there will be an increase in the supply. That is definitely there because there's an incentive to lend to something that for the same exposure has lower risk weights, but also it will have a portfolio impact in the sense that there will be more incentive to lend to green. So it has an impact on the particular loans, but also it has a portfolio impact that is important that we take into consideration. Let me just move to the conclusions. I think it has taken longer than expected. Let's move to the conclusions. Well, let me just conclude this presentation saying that, as I probably convey throughout all my presentations, central banks and financial regulators have increasingly recognized the potential impacts of climate change on individual institutions, but also on the financial system as a whole. Of all the things that I told you, I think you want to focus on the issue of climate stress testing based on a scenario analysis, because this is gaining traction, is gaining momentum. There is a need to draw scenarios on physical and transition risk with common assumptions. And this is quite a daunting task. I'm working on that. And I can tell you that we economists are completely in the hands of climate scientists. Generally, the integrated assessment models with the flexibility to use short-term time horizons and granularity by region and ideally by sector is the way where we are progressing. For the reason that I mentioned, integrate the climate models with the macro variables in a way that can be used by the traditional macro modeling. And also highlight that still there will be a need for expert judgment, because the scenario outputs need to be financially interpreted in terms of corporate financial terms in order to bridge the gap between the scenarios and financial risk assessment. Next slide, please. Well, if it doesn't here, and there is another one, Jet, another click, Juan. I think it's important to say thank you for your attention. Sorry, it has taken longer than expected. The technology has been, in spite of Juan's efforts, probably moving a little bit slowly, but also probably has also given you the time to better understand what I wanted to convey. Thank you all. Thank you.